Hello friends, my name is Abhishek Mishra. Today we are going to talk about mutual fund distributor certification examination, and it's about chapter 2, which is about concept and role of mutual funds. In this video we will talk about part 2 of the chapter 2, where we'll discuss some of the mock test. Let's start with the first question. What indicates how much money can be generated per unit of mutual fund in case the scheme is liquidated? Is it asset under management? No, asset under management is nothing but the overall fund managed by a particular scheme. So it cannot be the amount per unit of mutual funds. Is it net asset value? Yes, NAV. You might have heard about it many times in the conversations that NAV is nothing but a price of a per unit mutual fund of a particular scheme. Third, market price is not a standard term which is used in the mutual fund industry. Fourth is the exit load. Exit load is basically when you exit a particular fund in a given time period, you have to pay certain load, and that is called exit load. So answer for the very first question is option number 2. Move to question number 2. Each mutual fund scheme must have a stated investment objective, whether it's a true or false. It's very much true. It is very much required. So any mutual fund scheme cannot exist without having a defined, documented investment objective. The option which is correct is option 1, true. Move to question number 3. Which of the following is an advantage of mutual funds? Customized portfolio, it is not an advantage, it is a disadvantage, because for mutual funds offers a same portfolio for a number of customers who subscribe to a particular scheme. So let's say there is a fund called large cap fund. So mutual fund manager will create a portfolio of 30, 40 or 50 stocks and some debt and money market securities, and this will be applicable to all the investors who are investing there. So customized portfolio is not an advantage for mutual funds. Second, convenience to buy stocks and bonds directly from the mutual funds. From the mutual fund, an investor doesn't buy stocks or bond. Investor buys mutual fund unit. It's a indirectly buying stocks and bond, not a directly buying. Third is economies of scale. Economies of scale is a benefit, is an advantage of mutual funds. For example, if you want to get exposure into a particular sector of particular, market capitalization, companies. For example, you want to invest into large cap companies. So you want to invest into 30 large cap companies. So if you want to go and buy individual share of these, you have to spend more, as a investment ticket size will be more and your cost will increase. So here comes mutual funds as a savior, where you can invest into a mutual fund scheme. That mutual fund scheme can invest into variety of places, and your investment could be as low as maybe 500, 1000 or 100 rupees. It's very effective in that sense. So the advantage of mutual fund for given option 3 is the correct one. Let's move to fourth question. The transparency level in mutual funds are very low. State true or false? It's false, because mutual fund industry is very much regulated by SEBI, and the Association of Mutual Funds in India, they have also put a set of rules and ethics on, and governance structure through which every of the AMCs they abide by. So transparency level in mutual funds are very high. So this is a false statement. Let's move to question number 5. Which amongst the following categories of mutual funds have a fixed maturity date? Open-ended fund, they don't have a fixed maturity date. You can always invest and sell it. Exchange traded fund, this is also not. They are open on a stock exchange. You can always go and buy and sell in them. The third one is FMPs. FMPs are nothing but fixed maturity plan. Name itself says that this is a fixed maturity plan, or it is a type of debt fund which has a fixed maturity date. So option 3 is the correct option. Fourth is the interval funds. So interval funds are generally closed-ended fund, but they open on a given interval for certain days. For example, 2 to 15 days, that's when they open. Anybody can sell their units or someone else can buy the units. So such funds are called interval funds. So the option for this one is option 3, FMPs. Question number 4. Question number 6. Mutual funds can also act as a market stabilizer in countering large inflows or outflows from the foreign investor. Is it true or false? It is absolutely true. The option 1 is correct. Because many times FIIs, the foreign institutional investors, they sell off due to some reason. In that case, someone needs to be a buyer of those securities. So mutual funds, because they are having a lot of money pooled by investors, they can act as a market stabilizers. So option 1 is correct here. The primary objective of its scheme is to generate a steady stream of income through investment in fixed income security. Is it overnight fund, hybrid fund, equity fund, long duration fund? So there are two important things here. A steady stream of income. The second is fixed income securities. So hybrid fund, option 2. Let's look at first rule out some of the option. Overnight fund is a very short duration fund, like it invests into those securities where maturity period is 1 day, overnight. Okay, so these are like super liquid fund if I have to define them. So they are not a steady stream income generator. Okay, they invest mostly into money market or call market securities. Hybrid is a mix of equity and bond. Again, this may not be the answer. Third is equity. It's a pure equity fund, so it cannot be answer. The fourth is a long duration fund. So long duration fund is a fixed income fund which invest into fixed income securities that those securities have got a long maturity period, so they can generate regular or stream income, regular or steady income. So option 4 is the right answer. Question number 8. In line of the which of the following the scheme would decide the investment universe, the type of securities to invest? Return decides, safety decide, investment objective, or liquidity. Remember, the type of security to invest in, if a fund has to decide that will be based only on the investment objective. Option 3 is correct. Return is important, safety is important, liquidity. These three others are primary factor for evaluating investments. But who decides where the money, which type of security has to be invested in? It is investment objective. Any profits in mutual fund investment goes to investor while losses are borne by fund manager or AMC. Straight true or false? It's a false, because whether it's a profit or loss by mutual fund investment, it is borne by the investor itself. It is not borne by the fund manager. You might have heard about mutual fund investments are subject to market risk. So that is what is told in each and every advertisement to investors. That means if there are any profits or if there are any losses, that all have to be borne by fund manager or AMs. Not by the fund manager, but by the investor. So the option 2 is correct here, which is the statement itself is a false. A mutual fund scheme with the objective of providing liquidity would invest in money market instrument or debt paper of short-term maturity. It's so which of objective or instrument we are talking about here? Whether it's a money market, debt papers of long-term maturity, or blue chip stock objectives. So third, blue chip stocks is not an option. Money market is one, and debt market of long-term maturity is more of a debenture security, fixed income security. It is not meant for liquidity. So only option 1 is correct. The funds that combines features of both open-ended and closed-ended schemes are interval fund, dual funds, middle fund, intermediary funds. Second, third, and fourth, they don't exist as a fund. Only first one exists, interval funds. So interval funds are generally closed-ended funds, but they open for certain period, for 2 days to 15 days in between, and that's when investors can buy and sell from the fund itself. So option 1 correct. Question number 12. Which of the following is not a limitation of mutual funds? Lack of portfolio customization. Yes, this is a limitation. No control over cost. Yes, that's a limitation. No guaranteed returns. Absolutely. Fourth is a transparency. So transparency is not a limitation. It's a benefit or advantage of mutual funds. So option 4 is a correct option. Which type of valuation is usually done on a daily basis for the calculation of daily NAV of a mutual fund scheme? Mark to market, mark to model, both. So option 1, mark to model, is the correct answer. Why? Mark to market means you have to you have to do pricing of a fund or a scheme based on what is the last price or what is the price of the particular security which is being sold in the market. So remember, mark to market is marking a fund scheme to market price of securities. Now coming to second one, so option 1 is correct. Now let's talk about what is mark to model. So mark to model is a where there is certain securities which are not traded very frequently, especially on the debenture side. So they have to be valuated on a certain principle, on a certain formula. Such formula, if you just imagine, formula is nothing but a model. When you apply such method to a debenture securities or certain valuation methodology, we are calling it mark to model, where you are defining or discovering the price based on a formula or based on a model. Question number 14. Which of the following are the systematic approaches to investments offered by mutual fund? SIP, SWP, STP. Systematic investment plan, systematic withdrawal, and systematic transfer. All of these are systematic approaches. So option 4 is correct. In SIP, systematic investment, you put your money in a fund from your bank account every month or every quarterly or weekly, whatever is the frequency you have chosen. Systematic withdrawal plan is you already invested some money in a fund. Now you are taking a certain fixed amount or variable amount every month, every quarterly, and it's systematically withdrawing from fund to your bank account. Third is a systematic transfer plan. This is nothing but combination of SIP and SWP. STP is withdrawing your money from one fund and transferring or investing into another fund. That is called STP. Anyway, option for this is option 4. All of these are correct. The question number 15. The cost incurred for managing the scheme are shared by all unit holders in proportion to the holding of their units in equal proportion as decided by SEBI, none of the above. So see, if someone has invested 5,000, someone has invested 5 crore, if it will be equally divided among all unit holders, someone who has invested less, they have to bear the most cost. So option 2 cannot be the right. Third is SEBI. SEBI does not decide any formula. SEBI just defines that a particular fund with a particular AUM size cannot charge more than this particular amount. Okay, so they decide limit, so option 3 cannot be here. So option 1, in proportion to their holding of units in scheme. So generally, for example, if total expense ratio, TER, that's what it's called. So if TER of a fund is, let's say, 1%, someone investing 10,000 will have to pay, it's part of the NAV itself, 1% of 10,000, which is 100 rupees. Okay, and someone investing 1 lakh, that person has to shell out 1,000 rupees, and it is adjusted in NAV. Nobody has to pay it out of the pocket. So option 1 is correct. Which of the following are the factors of cost advantages for investors for mutual fund investment? SEBI has imposed certain limits on the expenses that can be charged to any scheme. Bilkul sahi. This is absolutely right. Second, many schemes that operate at expenses much lower than the limits allowed by the regulator. So these two factors, option 1 and option 2, both of them are advantageous factor for investors who are investing into mutual funds. How does a closed-ended fund make arrangement for providing liquidity post-NFO to investors? So fund managers allows redemption in exceptional circumstances? No. In case of closed-ended funded, the fund itself get listed on the stock exchange as one of the shares, and if someone wants to sell their units, they have to go and sell it on a stock exchange. So what can happen when a person goes and sell out its units? He or she may or may not find a buyer. If they don't find a buyer, they will not be able to sell it, right? But if they find a buyer, then their price will be agreed between them. It's more of market dominated. So It's not it will not be same as NAV. The price will be always, most of the time it is discounted when the liquidity is low. But this is one of the way how closed-ended funds make arrangement for providing liquidity. Option 2 is the correct option here. Fund house facilitate the trade on stock exchange post its listing after NMO. Yes, no, sometimes. No. Fund house does not do that. Question number 19. Is it possible to have a multiple transaction price on a given day when closed-ended fund is traded on a stock exchange? So I explained in the other question, when someone is going to sell their units of the closed-ended fund, they have to put it on the stock exchange that they want to sell it. Now the other side, the buyers, they can have a different opinion. They would like to have a different transaction price. One can at a 10 o'clock can say, I want this price. The other person at 12 o'clock can have another price. So you can have a multiple prices. So the option 1 is correct here. Question number 20. The transactions period when interval schemes becomes open-ended can have a maximum and minimum duration value of these options. So correct option is option 3, minimum 2 days and maximum 15 days. Question number 21. An individual holding units in closed-ended funds and interval funds will certainly be able to sell the units on a stock exchange on a given day. Option 1, yes, there is guarantee of transaction. Second, depends upon availability of buyer, that fund and willingness to do transaction on an agreed price. The option 2 is correct. It's like acting like a share, a stock, where if there is a buyer and the buyer has a demand price, or ask price, where they will say, I want to buy these units at this price. If it is agreed by both parties, then only transaction will happen. So option 2 is the correct here. Question number 22. Which of these is not a benefit of ETF? ETFs provide additional liquidity. Yes, that's a benefit. So it's not the answer. Second, on a given day, there are multiple opportunities as price which investor can either enter or exit the fund. This is also a benefit of ETF. Then this means it's not an answer. Third is low cost. This is a benefit. Fourth is a portfolio customization. Portfolio customization is not a benefit of ETF or any other mutual fund. So option 4 is the correct answer because it is the only option which is not a benefit of ETF. Question number 23. How many maximum number of stocks a focused fund could hold? 25, 30, 50, depending upon fund manager. You might have heard about this fund category where there is a focused funds are there. Focused funds are those funds, they have a concentrated bets on certain number of stocks. So the maximum number of stocks allowed here is 30 stocks. Option 2 is correct here. Question number 24. Which of the following combination of fund type and lock-in period is correct? Retirement funds 5 years or retirement, whichever is earlier. It's absolutely correct. Children's fund 5 years a child attains age of maturity, whichever is earlier. It's absolutely okay. Third, equity linked savings scheme ELSS. It has a lock-in period of 3 years. So all 1, 2, 3 are correct. So option 4, all of these are correct here. Which of the following combination of fund type and average maturity of invested debt market or money market securities is correct? Liquid fund, debt or money market securities up to 90 days, 91 days maturity. It's absolutely right. Low duration debt or money market securities with the between 6 months and 12 months. It's also fine. Third is short duration debt and money market security with maturity 1 and 3 years, which is also fine. So all of these options are correct. Which of the following combination of fund type and average maturity of invested debt or money market securities is correct? Overnight fund invest into those securities or debt or money market having maturity of 1 day. It's absolutely right. Ultra short duration funds, these are the debt securities which are whose maturity between 3 months and 6 months. It's absolutely correct. Third, money market securities with maturity up to 1 year. So all the 3 are correct. That means option 4 is correct here. Dynamic bond invest across debt securities, across only short duration debt security, only long maturity duration debt security, or across all duration or none of these. Option 3 is correct. That's why it is called dynamic bond. Dynamic means it keeps on changing. Whether you want to invest into short duration, maturity debt security, or longer duration or mid size, everywhere, all type of debt security, such funds invest into. Credit risk fund invest in securities with AA rating and below rated corporate bonds. This is absolutely right, because if it is AA plus, then it's a corporate bond fund. Always remember, that's a key difference between credit risk fund and corporate bond fund. Option 1 is correct. Securities with A rating wrong, third is wrong, and fourth is also wrong. So option 1 is correct. I would just say the answer which I have listed here in this presentation. By mistake, I have mentioned option 2, and the answer itself is correct, but option 2 is wrong. It's option 1. Okay, securities with AA credit rating and below rated corporate bonds. I'm really sorry, I just messed it up. So credit risk fund invest into option 3. The correct option is option 3, where the money is invested into AA credit rating and below rated corporate bonds. So option 3 is here correct one. 29. Corporate bond funds invest in securities with AA plus credit rating and below rated corporate bonds. See, the options, all of these options are same, but here the option is securities with AA credit rating and above rated corporate bonds. Remember, the only difference on the corporate bond and credit risk fund is that one invest at a corporate bond invest at a AA plus credit rating and above corporate bonds, but credit risk invest into AA and below that, right? Aggressive hybrid funds investment universes. So remember, there are 3 type of hybrid funds: aggressive, moderate, and conservative. Moderate one is more of a balanced advantage fund, or sometimes we call it dynamic asset allocation. It's another flavor of it. So aggressive hybrid funds is where you have a more equity exposure. So equity between 65% and 80% of the total asset, and debt is the remaining one. Okay, similarly option 2 and option 4. So option 1 is the correct one, where you invest at least 65 to 80% of the total assets into equity and remaining into the debt. Question number 31. Which of the following is incorrect regarding multi-asset fund? Investing in at least 3 asset classes, that's right. A minimum allocation of at least 10% in all the 3 asset classes, this is also correct. Foreign securities are treated as a separate asset class. They are not treated as a separate asset class. They are treated within equity. Fourth is it's an open-ended scheme. So open-ended scheme, it's not necessary. So option 3 is the correct one. Which of the following is correct regarding real estate mutual fund? Invest directly or indirectly in real estate? Yes, it may. SEBI regulation require at least 35% of the portfolio should be held in physical asset. That's absolutely right. Not less than 70% of the scheme shall be in real estate assets, mortgage-backed security. All of these are correct. Which of the following is correct regarding the valuation method of a real estate mutual fund? Assets held by fund will be valued every 90 days by 2 valuers accredited by credit rating agency. That's absolutely correct. The lower of the 2 values will be taken to calculate the NAV. This is also right. Third, these are closed-ended fund and have to be listed on stock exchange. So option 1, 2, 3, all of these are correct. So the answer is option 4, all of these. Which of the following real estate investments come under mutual fund preview? Real estate mutual fund, REITs, infrastructure investment trust, all of these. So real estate mutual funds come under mutual fund preview. REITs comes under SEBI, or it's a different set of you can say asset class, and InvITs also are the similar goes similar way. Which of the combination of fund types and their characteristics are correct? Smart beta funds rely less on market cap and include things like equal weightage or exposure based on additional parameter. Okay, so for example, there could be an index fund where there's a SDFC mutual funds fund where they invest into Nifty 50 in equal weightage, even though Nifty 50 constituent has a different weightage, but that particular fund gives option for investor if they want to treat all those Nifty 50 companies as a equal weightage and they want to invest in that way. So option one, smart beta funds, definition is absolutely right. Quant funds rely on data analysis and numbers and usually undertaken by machine to select the securities in portfolio, which is fine. It's more of a mathematics driven, data driven, machine driven funds where if there is a certain patterns, based on those patterns certain decisions are made. REITs are trust registered with SEBI that invest into commercial real estate. All of these are correct. These were all the questions for the chapter 2, and these all cover majority of the concepts. And if you like the video, please like and subscribe. I'll bring on the next videos on the chapter 3. Thank you. Bye bye.